Hello, everybody. This is Bob Klexis coming to you with All-Star Financial Quarterly Review, our third quarter 2011 webinar entitled Uncertainty Abounds, but Patience and Discipline Will Prevail. We want to welcome those of you who are clients and those of you who are potential clients. We bring you a market overview that basically emulates our newsletter that is just coming out today. But we want to make sure that for those of you who want to hear it via voice and kind of guide you through the newsletter where you might not have to read it, it's really in the format where we talk about the market overview. Market hates uncertainty, right? Well, there's a lot of uncertainty between Greece and are we going to go back into another recession, to the question of corporate earnings, debt ceiling debacle, again, kind of kicked it down the road, downgrade by the S&P. Has the U.S. Economy stalled? And we know a stalled airplane never goes back up before it goes back, or until it goes back down. And really something that has bothered me for the first time in my career is that I think we've been misled by the government, and we'll talk about that on the next page, which basically forced us to raise our cash positions in these uncertain times. So when we look at the U.S. economy, there's really a fear of that recession, and that recession fear, I think, is warranted. First quarter GDP originally was reported at 1.9%, but later revised down to 0.4. This is the first week in August, and the first time, like I said, that I really feel like I was lied to. 1.9% GDP for the first quarter we thought kept us on pace for a growth in the economy. 80% revision down, something's wrong. And we really took quick action. We took chips off the table. We'll talk about that. We also had a GDP for the second quarter at 1.3, revised down to official 1.0. The underlying weaknesses are there for many signals. The manufacturing has had marginal growth, the ISM manufacturing. The service side of the equation, modest growth, but the backlog has declined, so those are negatives. 2011 early, we had 200,000 jobs a month created. In August, basically, we had zero. Unemployment still at 9%. Home prices have dropped another 5%. So again, the question of the fear, I think, is really relevant of could we go back into a recession. We actually believe that there are some bright spots, though, and those bright spots are that spending has been up. Now, whether business spending can continue to go up and consumer spending will continue to remain at about 2% remains to be seen. We think there might be a self-fulfilling prophecy where, as things have turned down since the 1st of August, people will basically get a little frightened and stop spending. We do have mild inflation, which is obviously very good, and energy prices have come down considerably, which obviously leaves more money in the pockets of everybody involved. When we look at the U.S. economy going forward, then, we look at the forecast of reduced growth expectations. We're kind of in a fork in the road right now where are we going to maintain the slow growth or are we going to dip into a mild recession? And we really think that the market has already taken into consideration that we will go into a mild recession. If I were a betting man, I'd say it's a 75% chance that we will. And I'm not sure that that's not a bad thing, because I think that would promote a little bit of emphasis to get things done a little quicker, I would hope, by our governance. So what is a strong recovery going to require? It's going to require jobs, and I think that that's pretty simply stated, but monetary and fiscal policy can't do it anymore, so that strong recovery has to come from there. There is a thought process out there that eventually a business cycle runs its course, and even with little action or inaction, it can potentially nurse itself back to health. I would not like to see that as a forward-looking scenario, because that would be obviously a longer-term process. When we look at the bond market really for the quarter was unbelievably profitable for the long-term bonds, with all of the the questions and concerns going on in our economy here and overseas, people kept on looking at the U.S. Treasury as a safe haven, even up against the downgrade and the debt ceiling concerns. Government bonds, short-term, were up about 5.9. TIPS, inflation-protected bonds, were up about 4.5. Long-term governments, almost 24%. Unbelievable quarter for them. Credit-related bonds were weaker. Credit-related meaning corporate bonds that have some creditworthiness involved in their pricing. And we saw that investment-grade corporates did better than high yields, and emerging debt obviously did fairly poorly. So we look at kind of bond market going forward as the treasuries have kind of had their day in the sun, and I know we've been saying that for a while, but there's limited upside potential, not much more room for a decrease in yield to the 10-year treasury right now. It dipped down below 2% at 1.67%. Now it's back up to about 2%. But even that, you have inflation risk, that your money's really losing against inflation. Where we think the money should be on the bond side of the world right now is more in the corporate high yield bonds that are yielding 8%, as well as the emerging market bonds at about 6%, and investment grade corporate bonds at about 4.5% yields. So the areas that really haven't done as well this last quarter, we look at as something that has some upside potential. Let's talk about the domestic stock market, or may not, or not. Broad sell-off. All you can say is that, you know, the broadest measurement, the Russell 3000, 98% of the stocks on average lost 15.3% in one quarter. Large caps, mid caps, small caps, that increasing risk obviously was associated with an increasing decrease, and minus 21.9% loss for the small caps. Growth stocks did a little bit better than value stocks, which is kind of surprising because value stocks have that dividend component. And then financials and materials and the darling energy stocks took a huge hit too. So just a broad sell-off. What we look at kind of going forward for the domestic stock market is answered by the question, will corporate profits maintain themselves? Or, you know, will the positives kind of go away because they start hoarding cash? They have more cash than they've had for a long time. Well, corporations have reduced their debt. The PE ratios right now are at a huge, huge value. Average PE in the domestic market's about 11, where the average typically is 17. The average in the last 3 recessions is more like 13.5 to 14. So we're at probably the best pricing we've been at for a long time. We've got some dividend-paying stocks that have a solid opportunity. But again, our big question is there going to be a self-fulfilling prophecy? And that's that companies stop spending, individuals stop spending, and that recession obviously will happen probably. On the international side, all you have to say there is worse than the U.S., significantly worse. We saw the broad market ex-U.S., S&P Global broad market down almost 20. The EFE index, which is established Europe, Asia, Far East, is what FE stands for, down 19. We had emerging markets down 22.6, Europe down 22.6 as a continent, and then Japan actually did probably the best at just a minus 6.4. So looking forward on the stock markets, we still are steadfast in that our emerging exposure, which really has hurt us the last 3 quarters more than it's helped us, is still a solid value. The stories are still there. The last 10 years, everybody, the average rate of return on 9/30 of 2011, going back 10 years, is 16% annualized rate of return, even with the negatives we've seen the last 3 quarters. Demographics basically prove out that there's an expanding middle class that requires that demand, which shows for growth. And it's the best value in the world right now. It's the best growth. So our PEG ratios are phenomenally inviting, and we're going to stick with our international exposure. Japan is improving after the catastrophe there. Europe, I guess right now it's really anybody's guess. So really, in summary, what we want to make sure you know is that we did take action at a time in early August where we felt betrayed by government information and GDP revision. We reduced our equity allocations anywhere from 22 to 32%. We reduced our bond exposures anywhere from 9 to 18%. And our next moves, we believe, are to start adding. We think a tactical and flexible style manager, or a couple of those, we will add when we feel we're getting close to the bottom. And with our 30% to 35% cash position right now, we want these people to be able to go into the market in a very, very short period of time and get that exposure for us. So these tactical managers sometimes can be as much as 0% in the market and as much as 100. So putting that cash back to work with bargains is the main concern that we have, and doing it quickly. But you also have to understand that markets bring value even in a recession. There's poor consumer sentiment whenever we have, and this is kind of the last page of our newsletter, but whenever you have the bottom of the bottom when it comes to consumers' feelings, the next 12 months, the average rates of returns in the market are of great, and this is our last page of our newsletter, so go to those newsletters, but anywhere from 17 to 25% return in the next 12 months when you feel the worst, and when you feel like it can't get any worse, that's the time you want to be in the market. The big question is, consumer confidence, has it hit the bottom? And could a recession depress confidence even more? And I guess that's the big question that we'll try to make that decision for you fairly soon. So very quickly, thank you for your continued trust in the All-Star team. Remember our referral program. We've done a phenomenal job on the downside. Tell your friends and family about it. We'd love to get them in as our clients. And again, contact information. Do not hesitate to give us a call for whatever question or concern that you may have at any time down the road. So thank you, everybody, for your patience, and we'll look forward to talking to you soon.